Welcome, everyone. I am Gershon Margolis. I'm the founder of Imperial Advisory, and welcome to our Business Health webinar series. I'm going to take a moment to start by welcoming some of our team members. Then I'm going to take a moment and introduce the firm, and then I'll do a brief intro on our speakers, and then let them introduce themselves further, and we'll jump into it. All right. So for starters, I'm going to just look through in no particular order. That's what I see on the screen. Thank you, Elizabeth and Maggie Backup, for putting this together. Welcome, Rick. We'll hear more from you soon. Welcome, Dean. And then welcome, Tom Amato. Welcome, Ken.
Thanks.
Special treat to have you here today. And welcome to the other team members whose faces I can't see, but it's good to have you too. All right. So without further ado, let's get started. So let me tell you a little bit about Imperial Advisory. We are a CFO company. We provide fractional CFO services. So practically what that means, we provide CFO level financial leadership to growing businesses. And we come in either as a fractional CFO for some sort of project, or as an interim solution when a senior finance leader exits. We typically work with two profiles of clients, either CEOs of successful growing companies who need strategic financial leadership but aren't ready for or don't need a full-time CFO. We work with people like that on growth planning, cash flow, profitability, leading the financial team and infrastructure, preparing for transactions and or an eventual exit. Second profile is CFOs of larger organizations. So those are typically going to be, between 50 million and 500 million. So, or a division of a larger company. So figure a $200 million division of a $1 billion company. Anyway, CFOs at companies like that often need an experienced outside resource to handle complex work like FP&A, prepping for an audit, prepping for M&A, buy side, sell side, often project driven, not always, sometimes it's ongoing. But anyway, when they bump into situations where they have a bandwidth or expertise gap, they call on us. Now, what sets us apart from others, or what we think is really good about us, let's focus on us, not others. All the CFOs on our team bring decades of experience. All of them have over 30 years of experience. And generally, we've got at least 10 years, sometimes 20 or more, sitting in the CFO seat. And the people on our team really bring a wide range of experience. They've been in many different industries and in many different company sizes. I like to say that we're bringing large company perspective to the small business space. Anyway, we don't send consultants. The people on our team have been there, have lived the life, have been in that seat. And that's a big part of what we're providing, what we provide to our clients. We work closely with CPA firms, providing hands-on financial leadership that complements the tax and compliance work that many companies are already receiving. So we complement your CPA firm. We're not there to replace them. If you are a CPA firm, we're there to help you. Anyway, we also work closely with attorneys and bankers to provide strategic financial assistance, whether it's on a project basis or an ongoing basis to their client base, I should say. And that's our story. That's what we do. And we're able to help these companies grow, improve problems, or just prep for their next level of growth. Anyway, that's the story. That's a little bit about who we are. And one of the things that we bring is the people on our team have been operators. They've been in that seat and they end up touching many different parts of the business. And so our business health series is really to cover not just finance, but many different aspects of a business that we feel are important for our clients and others in our network to know. Today's topic, though, really is very close to finance because it's really finance. It's part of finance. If you sell stuff but you don't collect the money, did you really sell it? It's like the tree and forest, right? You spent the money on cost of goods, but you don't collect. That's a real problem. So making sure you get your money and making sure you get it quick, because if you get it in a year and then you have to spend money financing your receivables, that's also pretty expensive. So making sure that you get paid on time, don't end up wasting operational resources on collections that you should have never had to be wasting time on. Those are all really important things. And so I'm really excited to have our webinar today on this topic of how to solve problems, how to avoid problems around receivables, how to solve problems, how to plan for growth. And we're really excited to have Rick Katz. Rick Katz is one of our amazing CFOs. He hails from Texas, but he's been all over the world, as you'll soon hear. And Texas, Atlanta, South Africa. And Rick is going to be walking us through some strategies. Really excited about that. I'm going to let Rick take over in 1 second. We have a second speaker along with Rick, who's Ryan. Ryan has been in the credit insurance business for a very long time. And credit insurance is one of the many tools that you can, well, tools or tactics that you can use in planning and optimizing your accounts receivable. And Rick and Ryan have worked together, and we're so excited to have them co-presenting today. Rick, take it away.
Thanks,
Introduce yourself. Let Ryan. You're welcome.
Good morning, everybody. As you heard, I'm originally from South Africa. I have been in the United States 40 years, and primarily I have been involved as CFO of a number of companies. I've also got a general management background. I'm a chartered accountant with a business degree, and I have done a variety of strategic and hands-on roll-up-your-sleeve activities over the years. So I feel I have a good kind of view of things, really from A to Z. And I hope to help you all today in terms of discussing this topic. I want to make it as interactive as possible. So please, I'm not putting slides on the screen. We're going to talk, and you can get a copy later. But if you have a question while I'm talking, please put it in, and we'll deal with it immediately, rather than collecting them till the end. And I think that would be a better experience for all of us. So I'm to introduce Ryan Morse. Ryan and I worked together where he solved some problems for me in a particular situation in terms of receivables or credit sales, as we call it here. And Ryan will be able to add that particular tactic or strategy and give you a full description and how it works and what it can do for you. Ryan, please introduce yourself.
Morning. Appreciate everyone's time being on the webinar today. As Rick mentioned, we've worked together many years ago. Don't want to date any of us on the call, but I've been in the trade credit insurance industry for over 15 years. Started my career off at Allianz Trade and now have been at Coface for about 12 to 13 years. Coface, briefly, we have about 100,000 customers around the world. We have risk underwriters and risk analysts in almost every single country. So I always say partnering with a company like Coface is like partnering with the strongest credit department in the world with a checkbook. As a partner, you have direct access to not just me as a sales VP, but also our direct risk analysts and underwriters who are making these decisions for your customers or you all over the world in all the countries that we operate in. So I appreciate the opportunity to be here today, and I will give it back to you, Rick.
Great. Thanks, Ryan. So let's get down to it and deep dive into protecting your credit sales. This is going to involve quite a lot of process discussion. I'm a believer in processes. I believe in avoidance is better than having to deal with it as a problem later on. And there are many aspects to being able to manage credit sales and, or as I call it, accounts receivable, to be a positive impact on the business. Protecting should be a basic business principle, but it is often about growing revenue without taking unnecessary payment risk. Strong credit practices help companies reduce bad debts, improve cash flow, and support profitable customer relationships. Remember, the sale is not complete until you are paid. And I'll give some examples just quick later on about that. So why protecting your credit sales matters? When we talk about credit sales, we're talking about mostly B2B. We're not talking about consumer, where the consumer normally pays at the time of purchase, but we're talking about B2B, which really is a backbone of most companies' revenue. But they also expose the business to delayed payments, defaults, and even fraud. Weak controls raise days sales outstanding, strain working capital, and increase write-offs. Well-managed receivables support healthier cash flow and more predictable forecasting. And we'll talk about that now. Cash flow management is the most dynamic, constantly changing aspect of finance and the root cause of many failures. This is especially important when growing your business. As you grow, your inventory grows, your receivables grow, and you need more working capital. So if your working capital gets stretched, people who grow too fast can get into more trouble than people who grow slowly. Payment discrepancies are a major profit leak, especially large retailers and supermarkets who have built-in deductions to increase their profitability. Supermarkets' net profit is as thin as between 1.5% and 3.5%. That's looking at the major national chains. So you can imagine if they can arbitrage your cash for even 30 days or 60 days, or if they can find reasons to short pay you, it really adds to their bottom line substantially. And that is something I have experienced working with companies like Kroger, Home Depot, Lowe's. They all have these built-in ways of finding areas to charge and to reduce what they pay. Core strategies to protect credit sales. A standard written credit policy. I know smaller companies may have difficulty, when you do an audit questionnaire and they ask you for the controls and who checks who. Obviously, in a smaller company, there's a limited number of people involved, but you can still have a process that will encourage smooth operations and keep you on top in terms of managing your AR, your receivables. Define approval criteria, standardized terms, credit limits, exception authority, and escalation rules. All should be a standard practice, and all should be written so people can see it, read it, and follow it. The other big area is screening customers thoroughly before extending terms. Review trade references, payment history, financial strength, ownership details, and risk indicators. User service if possible. Dun & Bradstreet, CreditSafe, and there are others, are good choices to use. Now, they cost money, but in terms of what they can do for you when you're adding a new customer, it pays in the long run that you have them there and that you are protecting yourself as much as possible. I would really recommend that. There are costs, but it's well worth it, and it's certainly better than a bad debt.
Can I jump in for a second?
Yes.
I want to add something to what Rick is saying, that it's not just about should I spend the money to protect myself, which you might say, okay, these guys, they're finance people, they're being too conservative. There's also the fact that sometimes you're going to look at things and you're going to say that's too risky, and then you're going to lose the sale. But if you avail yourselves of having policies like this and having things set up, you may end up doing more sales and more volume because you have that Dun & Bradstreet, or we'll talk about credit insurance later. But if you have a way of checking, you'll have cases which otherwise you might have turned down, which now you won't have to turn down because you'll be able to be confident. And so on the margin, a lot of these things can actually help you. You may end up rejecting some. Well, it'll cost you money up front. You may end up rejecting some, but you may end up accepting others. So on the margin, it may actually increase sales.
Thanks, dear John.
That's a thought. If you don't agree with that, that was an unprepared remark.
But my next point actually leads into some of that. You match your terms to risk. Use shorter terms if you have any doubts. Use deposits. For smaller companies, even use credit card payment for smaller amounts. Personal guarantees where an owner runs a business, and prepayments to cover your costs, at least your costs of whatever you're supplying for higher risk accounts. I do not support using cash discounts. It's expensive. They never come when you expect them. And then you start arguing about you were 4 days late, 5 days late. Well, I sent it. I didn't send it. I've refrained throughout my career of offering or agreeing to cash discounts. It's more expensive than it is saving you money. They are expensive generally. Then monitor exposure continuously. At least weekly, you should have a tracking system with outstanding balances, aging trends, concentration risk, and sudden order spikes. And that's one is really special in industries where there may be changes in their activity. They may have difficulty and need cash flow, and they place a double or triple size order, and then you don't get paid for ages. There should be good reasons before somebody gives you a massive order compared to what they do regularly. Then getting down to the basics. Invoice
Question.
Yes.
Is that generally a red flag if someone has a big order, or is that just a risk to you because it's out of...
Yeah, Rick,
If it's unusual, I would want to know why. Yes.
Rick, can I jump in real quick?
Please, please.
I think this is an excellent point, that Rick made, with the unusual orders. So we saw a lot of companies, obviously when COVID hit and then as volatility continued to increase after all the government aid kind of fizzled out, we saw an increase in Chapter 11 bankruptcies. And typically what we'll see a couple big orders because they're preparing to file for Chapter 11 and they know when they file for Chapter 11, they're going to have difficulties with some of their suppliers who will not supply them product when they file for Chapter 11. So what we'll see an uptick in those orders for companies that are starting to go downhill and are about to file for Chapter 11. So I think Rick's point here often goes overlooked. So I've met with hundreds of credit departments in my 15 years of doing this. And a lot of the times they will be so excited because the sales guys like me will be like, oh, I got this $1 million order. I've spent years developing this relationship and we're getting this business, they used to work with this supplier, but this supplier's, not going to sell them as much and they're all excited. But what'll typically happen is, let's say they are a COFOS customer, their other supplier that's been supplying them. Well, we've probably notified them and said, this is a huge risk. We see them on the verge of bankruptcy, and then so this new supplier whose sales agent's all excited about this big order, they don't have credit insurance or they don't have a good, they don't know that there's all this inner stuff going on. So now they make that big order and now they're on the hook for a significant amount of, it's a problem. So I think that is a really good point, Rick. And I just wanted to stress that because we do see that a lot and we look for that internally as well. So great point.
Thank you. Appreciate that. So invoicing, clear invoices, purchase order alignment. It must be the same as their purchase order, and prompt delivery, reduce disputes and payment delays. Make sure invoice pricing aligns with customers' orders. Proof of delivery must be included where required. If you slip up on your invoice to start with, you can expect 30 to 45 days to get that invoice paid. It immediately creates an area for a customer to delay. Make payments easy. Accept convenient payment methods and have clear remittance instructions. More and more today, companies are going to ACH payments. They're not sitting and writing out checks and signing checks. Make that available. It's in your bank, and it'll be met because it won't bounce. ACH is in tin. Large companies have strict protocols to issue payments. Be careful. And often AP is located separately from multiple receiving points. Bear that in mind. Normally, the receiving point has to approve it in terms of whatever documentation until it reaches the accounts payable department. And if there's any miscontact between those two, you will not get paid until it's sorted out. Prioritize collections early. Use reminders on due dates and act quickly on past due accounts. So there's some obvious debate on how and when you take action. But if you have payers that are important and you know that they are prone to pay 2-3 days late, advise them it's coming due. I had my AP clerk who dealt with incoming payments have personal relationships with the customer accounts payable department. They get to know each other. They work with each other. And if you're the one who's working with the accounts payable clerk, you've got a better chance of being paid on time regularly. And if there's a problem, use the telephone. I find too much is trying to be done by email only. Talking is a far better way to deal with these matters from day one. Emails sometimes aren't even read.
Can I jump in again, Rick?
Carry on, please.
I think this is another absolute must reiterate this point. So we're seeing a significant increase in fraudulent activity, and AI has only increased that. We meet with FBI folks regularly here at COFOS. And to Rick's point, picking up the phone and developing these relationships is so critical versus emails, because a lot of the time, sometimes people are faking, that they work for this company and they send the emails. I dealt with this with one of my clients. He's like, Ryan, this company got approved for 100,000, but something seems a little off. And so I put the entire email chain through Microsoft Copilot and it red flagged, little tiny pieces of the email. And I said, well, did you pick up the phone and call this person to see if he actually worked for this company? And he's like, well, no, it's just been emails. And so to Rick's point, picking up the phone is critical, not just to develop that relationship, but also to prevent being in a fraud situation where you're actually not dealing with, employees from the actual company you think you're dealing with. So great point, Rick.
Thank
Pick
you.
up the phone.
And in fact, I have an experience on the wrong side of that, where we were paying a supplier on a regular basis, and there was emails between the supplier and ourselves on the AP side, us, and an email arrived within a chain of emails from this supplier asking to change the bank account for the next ACH payment. Part of the same email chain. Well, it never came as far as me, but it got handled by the controller, who was probably busy, and we paid a fraudulent bank account. Not once, twice. Now, one of the checks got recovered because we acted as soon as we discovered it, but the other one got to China before we could get hold of it, and it was a net loss. Bam, about $29,000. So, and of course, there are much worse cases dealing on emails. We've all seen emails from the boss saying, I'm out of town and I need to pay this urgently. Please send this money here or there. So it affects this as well. It affects AR. Be aware of it.
I want to jump in and
And point
share.
too, I would just say that I think Vito has a hand up on
Yes.
question too.
Please.
Thank you so much. This is great. I work with a company that does collections, and the ACH has become such an important thing for not only for us, but for our clients. We pay their percentage on the 15th of every month. If you are an ACH client, you might get it the evening of the 14th in your bank account. We had a situation 2 years ago. The post office is terrible these days. And 2 years ago, we had a problem where several hundred clients didn't get their checks. And the next month, they didn't get their checks. And after 2 months, the company redid the checks. Well, of course, they had a note in there saying, don't cash the first one with this date on it. Oh my God, what a mess it was. So we try to let everybody know it's in their best interest. If we're going to be sending them money, they should use the ACH. It's secure, it's fast, and it's not expensive. It's cheap, right?
Yes, sir. Thank you.
Thank you.
So again, now after collections, we look at how we manage the business from a automation numbers point of view. Alerts, scoring, aging dashboards, and workflow tools improve consistency and speed. And what you're trying to do is have a cadence that works. You know when customers pay regularly. You know if there's a problem because they don't pay. You see it quickly on a report. Don't let it sit there. Include in all documentation proper contract terms drawn up by your attorney to protect your interest and reduce risk. Those terms are for your protection. It does not protect your customer. There's nothing they need in protection, and therefore don't be shy about it. It's very important that you don't leave loopholes, that they can come back with and delay payments and say this doesn't tie up with that or whatever. Every order form, confirmation, and invoice needs to have the same information, the same warnings, and worded for maximum protection. Then we come to consider transfer risks, which is another way of saying some kind of insurance. I worked with Ryan, and he did a very specific insurance for us. But one of our partners, a large German organization that we would insured all their debts worldwide always. So they say they didn't need a credit department. You either within your terms and you paid, or you were handed over to the insurance and something was done immediately, or future orders were stopped. We didn't want that because we had large customers that we've been dealing with for a long time. But we had some that were in more risky industries, or some new ones, or some overseas. And letters of credit aren't popular because, again, they could put wording in there that doesn't really get you your money. I've had experience with that over the years. So letters of credit aren't an answer. The answer is really insurance when it comes to overseas. So Ryan, over to you.
Perfect. Thanks, Rick. And I want to clarify too, our company has actually implemented a new product line where outside of the trade credit insurance, we'll monitor the financial stability of key suppliers and key customers all over the world for our clients outside of the trade credit insurance. So that's a lot less expensive than trade credit insurance. It doesn't come with the same level of protection, obviously, as the insurance, but it's superior to a lot of the other credit reporting companies out there because our money is actually backing up that info. The other thing that I might add too, so if for anybody who's not familiar with trade credit insurance, there's three main players that have the breadth as COFAS. So it's COFAS. Rick mentioned Euler Hermes in the email, but now they're Allianz Trade. They rebranded, not to bash our competition because I love the folks over there, but they did a lot of canceling of coverage during COVID. And so they rebranded as Allianz Trade, which was a fantastic marketing strategy they did. But anyway, so it's COFAS, Allianz Trade, and Atradius have the risk analysts, the risk underwriters, and the full breadth of, all of this data globally. And then there's a lot of other trade credit insurance carriers that really, like AIG, will put the onus on the customer to make sure they're dotting the I's, crossing the T's, make sure they're monitoring their own, accounts. But if you want that true partner that has the 4,000 plus risk analysts, risk underwriters in almost every country in the world, that's us, or it's Atradius, or it's Allianz Trade. One thing I wanted to reiterate what Rick said is a couple different things that I thought were really important is really, really make sure all your invoices and everything have all the key data that Rick mentioned, and make sure that you do have maybe an in-house attorney kind of look it over. Make sure the purchase orders that are coming in, the company that you're doing business with is actually the company, that's legally responsible for paying you. So if you see a purchase order with a different company name, they're like, well, yeah, that's a similar company. Well, a lot of the times it's, totally, it's a total different legal entity that they're telling you. So they're like, well, yeah, that's us, pay us over here. Well, we're seeing a significant increase in the amount of fraud, but we're also seeing a significant increase in, let's say this big company has like 100 subsidiaries, and those 100 subsidiaries aren't all wholly legally owned by the top parent, right? So they're all separate legal entities. While the parent might offload a bunch of debt into subsidiary A, subsidiary B, subsidiary C, and then the parent will say, well, you guys go use Chapter 11 as a business tool, or whatever they want them to do. And so you think you're doing business with this big conglomerate and they're safe. Well, really, that's not the case. You're doing business with this little sub that is going to use Chapter 11 as a business tool. You're on the hook for all that. Meanwhile, you thought you were doing business with this huge conglomerate. And that happens a lot more than people think. I deal with that almost every single day. I'm dealing with it this morning. I'm getting pushed to get 5 million in coverage on this company. And they're like, oh, this company in South America is like the Exxon Mobils of the world. And I'm like, well, actually, these are separate legal entities, and they can force this company in Argentina to go bankrupt on their own. The parent's not going to guarantee these receivables. So I think the biggest point that I'll make to Rick's point is, times have changed. AI has significantly increased the amount of fraud that we're seeing. And to Rick's point, you really want to put a lot of effort on the front end of screening your customers. I connect with everybody on LinkedIn before I even talk to them for the most part. If a prospect reaches out to me, leaves me a voicemail on my phone, I immediately see if they have a LinkedIn profile. I immediately see who they're connected to. I see if we have clients that are doing business with them. And I put a lot of effort into, trying to figure out, okay, who's coming to us looking for trade credit insurance and wants to partner with us? Is that a fraudulent situation? Do they have somebody that they're worried about that might owe them $1 million and they're thinking they can just get credit insurance because, they're not getting paid by this company. So they're reaching out to us right away. So I just think that's a really good point that Rick made to make sure you.
Yeah, may I just say, yes, I didn't go into the detail that you mentioned. That is so vitally important, especially if you're dealing with Canada and Mexico, which is a lot of activity. And I've always insisted that the company placing the purchase order is the holding company or the company that we've got confirmed credit on and no one else. And they easily start switching that, and then you're in trouble. Very important. Yes. Thank you.
Yeah. And that's one of the three main reasons a claim will get denied in the trade credit insurance industry. So, for every dollar we collect in premium, we typically pay out about 45, 50 cents in claims. So we do pay a lot of claims. But one of the three main reasons a claim will not get paid is if we seek coverage on the wrong entity. So years ago when Target Canada went bankrupt, some people thought they were doing business with just the Target, so they put the coverage on Target US. Well, Target Canada went bankrupt, Target US didn't. Situation like that, we wouldn't pay a claim. In a fraudulent situation, we wouldn't pay the claim either. So, for example, I have a client, they sell oil and gas. Well, somebody ordered $50,000 worth of fuel, had it delivered. If this guy had just looked up where they wanted that delivery, it was a defunct gas station in North Carolina. So, if they just looked at Google Maps, if they called that location, they would have realized that that gas station's out of business. There's nobody there. And so they would have picked up on that. And that was a fraudulent case that wasn't covered under the trade credit insurance because we can't go after their customer for anything, right? Because it's a fraudulent order. So they shipped $50,000 worth of oil to this gas station and we're on the hook. And we're seeing that happen more and more. So that's another reason a claim will get denied. And then the other thing I'll mention too is when you're a partner of COFOS, it really gives you a lot more flexibility in your credit department, in your sales department. We kind of bridge that gap. So sales is coming to, the credit department saying, we need to approve this for $1 million. This is ridiculous, Rick. Why aren't you approving this? You're so conservative. This is costing us business. Well, Rick can then say, well, COFOS, because we have over 100,000 customers, chances are good we have clients that are also doing business with this entity. And so, yes, you might be getting paid on time, or they might share trade references, but who's ever going to share a negative trade reference, right? So with a partner like us, we have all that intel from our other customers. So for example, I'm dealing with this right now. I have a client that says, why are you not approving this? We have positive payment history, and I said, well, we have two other COFOS customers who have filed sizable six-figure claims on this same customer. So I really don't care that you're getting paid on time because that means nothing when two COFOS clients have filed over $100,000 in claims. And they said to me, they're like, are you serious? And I'm like, yeah, I'm looking right at it. And so, when the bankruptcy court comes in, they can come and take that money back, which a lot of people don't understand. The bankruptcy court can come back months and they can say, okay, well, you guys were getting paid on time, but those were preferential payments. And so what they do is they come and they claw that money back from you. So you could get $1 million taken from you that you were getting paid on time. And then that $1 million is going to be equally distributed to the other suppliers that are on that schedule of creditors in the bankruptcy court. So trade credit insurance also protects you from that. So we also cover those clawbacks. So if you're getting paid on time, a year goes by, and now the bankruptcy court comes to you and says, well, actually, you owe us $1 million. That's covered under the trade credit insurance program as well, which a lot of people don't know. So that's another thing. And we also underwrite the risk in those specific markets. So if you're exporting or you have clients or anybody that's looking to grow their sales, right now, with everything that's been happening, all the uncertainty going on, we have no idea. I mean, I haven't checked. I've been in meetings all day. Is the strait open today? Is it not open today? How is this going to play out? There's just so much uncertainty. And so our underwriters have the boots on the ground in those specific markets, and they're monitoring the economy in all those countries. They're monitoring all of the sector risk, country risk, and all of that becomes embedded into a company's entire credit and sales departments when they partner with a company like ours.
Great. Thank you.
When you say that money can get clawed back, does that only happen if the company has already declared bankruptcy, or the bankruptcy goes back and says you paid bills for the last 6 months or the last year, and we're going to go claw back money from all those people? How does that?
The latter. So if I understand the question correctly, so let's say, I'm selling widgets and, this company's paying me on time, and they've been paying me on time for the whole last year. but they're not paying 5 other suppliers on time. So now let's say 2 months later, this company that I've been selling to goes bankrupt. They start going through the bankruptcy. They start getting all the details. Months go by. Those bankruptcy proceedings take months. So now they're going through everything and they're realizing that, Ryan Morse Widget Company was getting paid $1 million like clockwork because, me and that, leadership team went to church and golfed together. So I had this personal relationship or whatever it have you, right? So I'm getting paid on time, but all these other people are not getting paid on time. You can see that clawback happen years in advance, which is why our policies cover, 3 years out if they come back and get that clawback, because it can happen years afterwards.
Exactly. Yes.
Yep.
Agreed.
We just saw that happen the other day. A client of mine from 3 years ago, they were getting paid on time. They were like, what is this? This bankruptcy, was 3 years ago. And now they're trying to collect this like $30,000. And we made a claim payment on that because we went back and it was a clawback. The bankruptcy court went through all the different bankruptcy stuff that they go through. And they came back and said, actually, hey, we found this 30 grand that you were paid 3 years ago. You now need to give this back to us and we need to equally distribute this to everybody else.
Yep. So just a couple of things about credit insurance. There are rules and there are regulations that they provide you, and they have to be kept. You have to report it when it's overdue. Don't try, and then suddenly, 30 days too late, you say, sorry, it's not being paid. They have their own controls and their own rules about reporting and staying up to date and changing credit terms and exceeding limits. All of that has to be taken into account. But if you do it right, you're well covered.
Yep. And to reiterate Rick's point, almost every single carrier in the marketplace has a lot more dotting of the I's and crossing of the T's to make sure a claim gets paid. With COFOS, we're a lot more lenient, but we still ask that you keep an eye out on things and keep us abreast. But you have a pretty large window. It's typically 180 days from the oldest invoice to file a claim. So if you invoice somebody January 1st, if they haven't paid you by July 1st, you really need to get that claim into us. Now, you can file a claim day one after it's past due if you really want to. One of the strategies I recommend is letting your client know you have trade credit insurance. And I always say putting the onus on the bank. So say, hey, look, we've partnered with COFOS for our trade credit insurance. They insure all our accounts receivable, and we do that so that we can offer more favorable credit terms to our clients like you, Mr. Customer. We do this so that we can get a more favorable working capital facility with our lender, which has enabled us to take on a lot more growth projects. But under the terms with our bank, we need to file a claim if you don't pay us within X amount of time. And we really don't want to have to file a claim, Mr. Customer, because COFOS has over 100,000 clients worldwide, and chances are very good that other suppliers of yours are utilizing COFOS. And if we file a claim, it's going to send off red flags with all of them, and it's going to negatively impact your business. And that is the last thing we want to have happen because we really care about your business. And that goes back to Rick's point about relationships. If you and everybody at your company put a lot of effort into building that relationship, you can have those conversations, and people won't think, oh, you have trade credit insurance because you think they're not going to pay you. No, that's not why people get trade credit insurance, right? So, I just wanted to reiterate that point. But that's a pretty large claim filing window. And obviously, I have clients that have 180-day terms. So that claim filing window isn't 180 days. It's way longer in that specific example. So we carve out the program. They're all customizable to whatever fits your needs. You don't have to insure anybody. You can insure just everybody that owes you $100,000 or more, or you can exclude Walmarts, Kmart's. We have the most amount of coverage on Walmart globally, so people do insure Walmart. I have a client that has a $10 million limit insured on Target. So, but you don't have to insure those entities.
Right. Okay, so let's move along to a few other areas that I want to cover briefly. Early warning signs to watch. They may sound obvious, but sometimes they're overlooked. And every organization has blind spots. Some things that you just don't notice or don't see, or for some reason skipped, went into a black hole. If payments start arriving later than usual, If customers request repeated extensions, order volume rises suddenly without a clear business reason, which we've discussed. There are organizational changes, layoffs, legal issues, adverse market signals affecting the customer. Be aware of all these. If you insure receivables, your insurance company will give you early warnings in a lot of these cases, and that's a big advantage of having it. Collections and escalation practices. Separate relationship management from risk management. Support sales, but avoid uncontrolled exposure. As Ryan mentioned, sales guys want to do sales. They don't want to collect money. I've had situations where the sales guy has asked to get involved, but they have an emotional reason not to upset the customer. You have a very vital business reason to get paid. So bear that in mind. Define what to place account, when to place an account on hold. There should be a standard procedure. I had a standard procedure. If a customer is 10 days late, no shipments until we've sorted it out, period. It may be a simple matter, but at least it was brought to attention before more got sold with a problem. This must include orders not yet produced. Don't go running up more in product which is unique to a customer when you're having a problem collecting what you've already delivered. Stock them. In rare cases where you need a long lead time and other issues, try and get deposits to cover at least your basic material and labor costs, or only your material costs. But take measures to protect the risk. You don't want to lose a customer, but you don't want to lose a lot of money. Remember also, be regular with your follow-ups. There's no harm in asking by telephone, why have I not been paid yet? They can give you a check number and something that you can stand by, fine. But also remember, the squeaky wheel gets the grease. So be the squeaky wheel. And I've seen that happen. When the automotive industry got into a little difficulty, we were quite big in the automotive business, a third of our business, and they started pushing out payments. So that got to CFO, and I discussed it with him. And we got better payment realizations than they were doing before. But he couldn't do that with everybody. So if you're not in the line at the first, you're going to land up in the line with everyone else. Those are important little things that happen along the way, but they all leave their mark and a lesson learned. And I mentioned CFO. Escalate unresolved delinquencies quickly to leadership, internal leadership, and then how leadership internally deals with it. Set a fixed time or set certain customer names. If they go late, let me know. We'll decide what to do. We'll look at the situation, the circumstances. CFO to CFO is better than owner to owner, or if it's controller to controller. They talk the same language, they may have the same problems, and they work with each other a little bit. If you're in the line first, review root causes of late payments to the process gaps. There may be reasons why you're getting paid late. There may be continual requests for copy invoices or for proofs of delivery, things like that, or short deliveries. They don't tell you about over deliveries. But all of these erode profit margins at the end of the day. Closing takeaways. Protecting credit sales is not about saying no. It is about approving the right risk with the right controls. Strongest results come from combining disciplined processes, policy, report monitoring, and follow-up. Senior people should be looking at reports at least monthly of the AR and the whole aging, and who's late and why, and what are we doing about it. It will not get fixed on its own. Even small process improvements can lower bad debts. Little things that I've just mentioned. Shorten collection cycles. Strengthen cash flow. Again, organizations should review their credit policy regularly as customer risk, the economy, and market conditions change. Ryan gave several examples of things that happen out there that come back and affect your business. Be aware of it. Take measures when you can. Be careful when you can. And consider this. If you have a net profit of 10%, it takes $100 of sales to recover $10 of write-off. If your profit's only 5%, $200 of sales to recover $10 bad debt. That's a big mountain. Don't put yourself in that position. Open to further Q&A, please.
I found that fascinating. I asked my questions along the way. Anyone else? Anyone have anything they want to jump in to ask our
I'll
speakers?
jump in for a question for Rick if nobody jumps in. My question to you, Rick, is in your many years of doing this, would you agree that a lot of businesses get into, not the term, but like too comfortable with some of their long-standing customers that they've done business with years, and then so they start, getting comfortable and selling more to those customers so that now, over 80% of their revenue comes from less than 20% of their customers. Did you find that in your career? And did you find that kind of now where companies are still getting too comfortable, and having so much of their revenue coming from such a handful of customers?
Generally, I mean, we were watching, the the amount of debt with any customer as a part of the total. And I don't think that we ever actually got to the point where it was too much because of comfortable. What was too much was giving extra terms when you get too comfortable. And
Yep.
then if they start buying more from you, the owner will say, I've known him for 20 years. Come on, there's no problem here. Well, he can be as honest as the day is long. But when he doesn't have the money, he doesn't have the money. If he's not making a profit, it's going to come back and hurt you somewhere. So, yeah, the point is well taken. It's an important issue. Yes, sir.
Yeah, I have a vested interest in the question, but I was curious. Do you generally use collection agencies? I know you have the insurance, and that's a fascinating approach, but how about collection agencies for clients?
Never, sir. I've never used a collection agency.
And can I ask why that is?
Well, first of all, because we've managed like over 90% of the time to get paid, even if it's late.
Okay.
Secondly of all, because the cost of collection can exceed what you're trying to collect. And I don't think the collection agency can be any more efficient than I can. That's
So I'm gonna jump in too. I'm gonna jump in too because I've been doing this for a long time, not as long as Rick. But so I've met with hundreds of credit departments, and I will say this: Rick is just on a whole nother level. So he might not use a collections company, but I have recommended to my clients to use collections companies because I find that collections companies are very, very good. They have all kinds of great tools. However, Rick is on a whole new level. And if you implement strategies that he's recommending we implement, you you won't need to use a collections company as much because of how great I've seen him do. I mean, I know personally when I worked, when one of his companies he worked for over the years, they had our service for a small part of their business, but I watched all the stuff that he had in place. But to your point, Vito, I meet with credit departments all the time and they don't do anything that Rick's talking about. None of the recommendations, they don't do any of it. And so I've always recommended that if a credit department is not going to implement all these internal strategies, which most of them don't, that yes, it does. It does add a lot of value to go with a collections company.
The idea here is that most people that I talk to, business owners, not the size companies that I think you are generally working with, but small business owners, people think that you got to be a guy named Vito from Jersey to be in a collection agency, which is really fun because I'm a coward. I don't do any collecting, but I love
a
this.
baseball bat, Vita.
But we are a fixed fee agency. So the average in America is 33%. That's the contingency fee. Whereas we have businesses that we collect their money for $20. The max is $30 on the flat fee side. And they are astounded because what happens is if you know it's going to cost you $20 or $30, you're not waiting 6 months or a year, which is also the average age when people put debt with collection agencies. So it's a high percentage and it's older debt. And that's why they get the result they get. Average around 9 or 10% today. Our average is much higher. Could be 20, 30, 40, 50% in some instances. We do a lot of medical and that, dentists and that kind of thing. But I appreciate your direct answer. And Ryan, I should have said on the survey that I wanted to talk to you.
Just reach out to us.
Okay,
We'll-
because
we can
I
get
think
you
that I would
guys in
like
touch.
to explain the details to you since you do use it sometimes. Thank you. This was
Um,
great. Thank you, guys.
Thank you. Thank you to all of our guests. If everyone could take a second to fill out the survey, that would be great. And thank you to our two speakers. We really appreciate all of your insights. And
Yeah, thank you. Great job.
if anyone has any questions, hopefully the speakers could stay for another minute or two. I have one thing I want to ask. The question is on the collections. Does who you're collecting from make a difference? So, like when you're collecting from Kroger's versus when you're collecting from a mom and pop business, does that change Rick, who I know is not a big fan of needing collections agencies, but would that change your approach?
Yes.
It
Yes.
could. It
And
could.
Vito can answer because, he can answer from his own collection standpoint. But for COFOS, we partner with Altus Receivable Management for all our collections. And so they do, every situation is different. So, a lot of the times if it's a Kroger or a company like that, and I'm not going to, Vito, you can hop in, but they're not going to take the same approach as if they're, dealing with somebody that they think is on the verge of bankruptcy. And
Yeah.
Vito, if you want to hop in and answer
Yeah,
that too.
just quickly, what we do is we have two types. We have a series of written demands that we use for that fixed fee. And there's one set of demands for consumer debt, and there's a set of demands for commercial debt. So that the language is different and it's very effective. Once it's used, when people get the demand, first class mail, and they look at it and they say, oh my God, we're in collections. They don't know who we are. They don't know it cost you $20. They don't know that. All they know is psychologically, oh my God, we're in collections. And that's the advantage when it's done early. If you're sending somebody a 2-year-old debt, a demand like that, they're ignoring everything. So this works because the best, happiest clients use us at 60 to 90 days. Everybody says 90 days, but they don't do it. When do you use 90 days? If they haven't paid in 90 days, we're going, no, you're not. Most people just don't do it. They know that's a good answer, but they don't do it.
And to
I'm only in
reiterate,
this 23 years, Ryan. I know you're
Yeah,
here 15. This is my second career, but the idea here is that it's an education thing. It's letting people know that there are options. You don't have to just browbeat people. We even have a reminder service that is not collections, same idea with the flat fee. But our clients were saying to us, look, I don't want to put these people in collections, but I don't have the staff that I once had to do the
That's right.
reminders. And so they like our little flat fee thing, 5 touches for the same flat fee. So, we're trying to be honoring what the clients are asking for. And I'll tell you this, and you can check any agency you're working with now. We have over 2,700 Google reviews nationally, and our average is 4.85 out of 5. And we're a collection agency. And over 70% of those, the debtors went beyond the flat fee. They had collectors calling them. They were so taken with the way the collectors treated them, they gave the collectors a 5-star review. We're very proud of that. So
Wow.
it's different. That's all I'm saying. It's different.
Yeah, and
All right.
I want to reiterate that too, because I think that's really important thing that he brought up is time, right? Our time is the most valuable thing all of us on this call have.
Yes.
It's the most valuable thing, right? So if you have people like Vito or company that we use who specialize in this arena, it's so much more ROI to, let them do it. And as a credit insurer, I like when people don't file claims, right? Because then I don't have to negotiate and spend hours of my time trying to keep their premiums low because they're having people try to help them collect that debt before it gets to the point where they even need to file a claim. So,
right.
if somebody files a large trade credit insurance claim, obviously it's like any other insurance, right? The premiums go up. And then I have to spend hours negotiating internally with my underwriters, my leadership team to keep those premiums low because they keep filing claims. So, I'm
I
all
appreciate
for
that, Ryan. That's so important. And one thing that we talk a lot about that wasn't mentioned, your work is protecting the staff in your clients' companies, because then they don't have to deal with those folks that are not paying. And in my experience, people in the companies that we're working for, they don't like collections. They don't want to do collection. I know that's their job, but it's not the most comfortable thing. And so this service helps them protect the clients and their staff. So that's a big point we talked about.
You know, if I may say, there's a very big difference in the different reasons why you're not getting paid. And if it's a straight, we haven't got the money, that's one story. If it's an argument about the quality of goods received, it's another story.
Yeah.
I mean, some of them should be resolved without having to collect. If there's just a straight out, you know, they're going to go under if we don't do something, then maybe I would get somebody else to do it.
Yeah.
But
And I didn't mention
I didn't have the facility or the services of Vita at that time. So,
well,
Yeah,
the other interesting thing is that we don't, on that flat fee, there's no percentage. So it's $20, it's $30, it's 18, depending on the volume of how many accounts. But you get paid directly from the debtor. It doesn't come through the agency. It's directly to the debtor. They love that. Business owners love that. So different paradigm.
And to go back to Rick's points, though, if companies and their credit departments would make everything, follow these strategies that he laid out, they're going to get paid, and they're not going to have to file as many things with a collections agency because the companies they're doing business with is going to take them far more serious if all of their invoices are perfect, if they have all the dotting of the I's and crossing the T's set up. So all these strategies, that I've seen Rick use over the years, it's companies should be using.
And that's why I don't need a collection agency.
Yeah, I know.
It was a
And
pleasure.
I would agree, Rick, you don't. But,
Yes,
a lot of companies don't follow those strategies, and they should be following those strategies. So,
All right. Thank you both. Thank you all for participating. Hope to see you again sometime soon.
Thank you.
Thank
Great
you.
day, everyone.
thank you guys.
Yeah.
Thanks, Ryan.